We talk a lot on here about blockchain projects, the tech, the tokens, but often there's a company, right? A foundation or some core team behind it. So what happens when that whole corporate structure just disappears, literally overnight? That's exactly what we're digging into today. The really dramatic situation with Kadena, we're doing a deep dive into the sudden shutdown of Kadena's operating company, a move that, well, it hammered the token price. KDA dropped 50% immediately. Our mission here isn't just to track the financial fallout, though that's definitely part of it. It's more using this as let's say, a live experiment. What happens when a managed blockchain, one with a company actively supporting it, suddenly pulls that support?
Completely, and leaves the supposedly decentralized network to just fend for itself. What should this tell you about these hybrid models? Part company, part decentralized network. Are they really viable long term?
It's a fascinating and honestly a pretty brutal case study. Kadena really puts that hybrid model under immense stress. Because this isn't just like a normal market dip. It's a fundamental test. When that corporate backing vanished, it forced the market to decide what it really valued. You see, Kadena tried to have it both ways. They had the decentralized Keck proof-of-work mining nodes all over the place, but they also had this very centralized, very traditional company structure managing things. The core code, the big partnerships, funding all that expensive development.
Yeah, the burn rate, always the burn rate.
Exactly. And when that central pillar just crumbles, the market reaction tells you loud and clear. A huge chunk of that asset's value was tied directly to the company, to the management team, and crucially, to the promise of what they would build next. It wasn't just about whether the blockchain itself was still technically online.
And that reaction was, as you said, brutal. Let's quantify that a bit. Kadena's announcement just cited, quote, adverse market conditions. Pretty standard stuff. But the impact wasn't standard. Announcing an immediate stop to all business operations, boom, KDA token drops 50%.
Yeah, and let's put that 50% drop in perspective because it sounds bad, but the context is even worse. That crash took the KDA token down to about 12 cents. $0.0121 to be precise. Now compare that to its peak back in 2021. It hit $27.64 then.
Wow. $27 to 12 cents.
Right. So we're talking more than a 99% drop from its all-time high.
Yeah.
It's an almost total wipeout of speculative value.
Which really hits that point you made earlier. If the network is truly decentralized, why would the company failing cause such a catastrophic asset collapse? Shouldn't the network just keep running?
It does keep running, technically, and that's the paradox.
Yeah.
But the market clearly wasn't pricing the asset base just on current uptime. People weren't selling off in a panic because they thought the blockchain would literally switch off tomorrow.
No, they were selling because the engine of future growth, the source of innovation, partnerships, adoption drives, that just died.
Precisely. The market treated KDA, for the most part, like a tech stock. Its value was deeply intertwined with the founders, their vision, their ability to execute and keep pushing the platform forward. So when the company folded, it shattered that confidence. It signaled the end of Kadena as a managed, growing ecosystem. That's what accelerated the sell-off far beyond just, technical concerns.
Okay, so let's be really clear about what actually stopped. Because it wasn't a gradual winding down, was it? The company didn't just lay people off, they ceased everything.
Pretty much everything related to active operations. The announcement said all business activity and active network support with immediate effect. So that means no more formal development on the core protocol, no more centrally managed network maintenance, no marketing budget, no one chasing corporate partnerships. It just stopped.
That's the end of the road for what you called the business-focused blockchain dream, then?
I think so, for Kadena at least. They launched back in 2020, made a fair bit of noise. But even with that pedigree, which we should talk about, they struggled. They struggled to gain real traction, real adoption in what's become a very, very competitive landscape for layer one blockchains.
And that pedigree was significant, right?
Yeah.
Let's talk about the founders, Stuart Popejoy, William Martino. These guys weren't just random crypto devs.
No, not at all. They came directly from JP Morgan's blockchain division. Serious players.
Yeah.
Institutional background.
Which signaled ambition and probably high costs. Running a serious operation like that isn't cheap.
Definitely. It implied a certain scale of operation and a certain level of corporate overhead. They weren't just coding in a garage. They had New York headquarters.
So what was the grand vision? What were they trying to build with this hybrid approach that needed that kind of structure?
They were aiming high. Enterprise-grade blockchain. Kadena was a proof-of-work platform like Bitcoin, but with smart contracts like Ethereum. And their pitch was bold. They claimed they could beat Bitcoin on scalability and security and offer more reliable, safer smart contracts than Ethereum. That was the promise.
And the core tech behind that scaling claim was something called Chainweb, wasn't it?
That's the one, Chainweb. It's technically quite clever, this braided, multi-chain proof-of-work architecture. The idea was it could scale by adding more chains almost infinitely in parallel.
Sounds complex.
Extremely complex. And that's where the hybrid model's weakness really showed up. Building and maintaining something that novel, that technically intricate, especially on proof of work, it requires enormous ongoing investment. You need a dedicated expert team for development, constant security audits, infrastructure maintenance. That means you need centralized funding, big funding.
Wait, so the very complexity they designed for scale actually ended up demanding more centralization and higher corporate costs.
That's the contradiction, isn't it? It's baked into a lot of these heavily VC-funded Layer 1 projects. You need the corporate structure, the VC checks, the headquarters, just to manage the sheer complexity and, frankly, the regulatory uncertainty around launching something so different.
So they had the overhead of a big tech company, but tied to the volatility of a crypto asset.
Exactly. And when the market turned sour, that overhead wasn't sustainable. The funding presumably dried up, and they had to pull the plug on the very development efforts that were supposed to justify the whole thing.
So it sounds like the tech itself didn't fail per se. It was the model. The structure couldn't weather the crypto winter.
I think that's a fair assessment. The hybrid approach, trying to blend top-down corporate development with bottom-up decentralization, it just buckled under financial pressure.
Okay. So the company's gone, doors shut, developers presumably looking for new jobs. The crucial question now is, what keeps the blockchain running? If the company's gone, who is running the show?
And this is where the decentralization part gets its real test. The Kadena blockchain itself, it actually is still running. It stays online purely because of that decentralized design element. You've got miners across the globe, third-party node operators running the software.
So people who aren't part of the company.
Right, independent operators. They continue validating transactions, adding blocks to the chain, securing the ledger. They can do that entirely without the original company coordinating or paying them. That's the nature of proof of work.
Okay, so the chain is alive. It's like this perpetual machine they built and set loose. But just surviving isn't the same as thriving.
Right?
Or even evolving. What are the real practical problems for the KDA token holders and anyone still interacting with the network without that central team?
Well, the outlook isn't great, realistically. Future growth, future innovation. The sources we looked at basically say that appears unlikely.
Right, because who's going to drive it?
Exactly. The network functions, sure. But think about governance. Who decides on the next critical upgrade? Who pays for it? Who manages the core code repository now? Who coordinates bug fixes?
That was Kadena Systems LLC, the company, handling security patches, pushing updates. That takes people, salaried people.
It does. Now that responsibility, theoretically, falls to the community. A scattered global group of miners, node operators, token holders. They have to somehow self-organize. They need to coordinate complex technical decisions, maybe even fund development, all without any formal leadership structure or dedicated budget. That's incredibly difficult.
Yeah, sounds of course impossible, practically speaking. So if you're a developer thinking about building an application, why would you choose Kadena now?
It's a tough sell. Why build on a chain where the core protocol development seems stalled, where there's no foundation providing grants or technical support, no roadmap? You'd likely choose a platform with active development and backing.
Which, in turn, hits the token holders. If no one's building on it, the utility of KDA just shrinks.
Significantly, it becomes less relevant. You'd expect platforms, exchanges, other services that may be integrated with Kadena, partly because of the company, they might start to pull back.
Less integration means less demand for the token.
Less demand, shrinking liquidity.
Yeah.
That's a downward spiral, potentially. The token's main value proposition was tied to the future growth of the ecosystem, and that future now looks, well, uncertain at best. Frozen, perhaps.
It's quite the cautionary tale. Though it is worth noting, the company did one last thing, right? They released a final software update.
Yeah, they mentioned planning a final binary release, kind of like a last technical handover, to ensure the network could continue running smoothly even after the core team completely disbanded.
So they didn't just brick it on the way out. They handed over the keys, basically.
They handed over the keys to a writing machine, yes. But the market saw that handover as the official end of the project's ambition, the end of institutional support and trust. The chain might run forever, technically, but without coordination, without funding, without a driving force for innovation, what's the long-term value? That's the question facing anyone still holding KDA.
It really throws a spotlight on a key vulnerability, doesn't it? Something for you, the listener, to really consider. How much risk is embedded in projects that rely so heavily on a central company, even if they fly the flag of decentralization? Because if that company is doing 90% of the heavy lifting for innovation, partnerships, marketing, what's left when it suddenly disappears?
And connecting that to the broader crypto space. Kadena forces us to ask uncomfortable questions about how much these founding companies really matter long term. If a layer one is truly decentralized, should the company behind it failing even be such a big deal? Kadena suggests that, yeah, it often is a very big deal, that corporate presence provides vital momentum, trust, and coordination that decentralization alone struggles to replicate, especially for complex systems.
It's a stark reminder that decentralizing the nodes is one thing. Decentralizing governance, the actual decision-making, funding, and development coordination, that's a whole different, much harder challenge.
Probably the hardest challenge in crypto, honestly. And Kadena's complexity, that chain web system, might have ironically made it more dependent on central control, not less. The tech was so advanced, it needed that high-cost corporate structure. When money ran out, the structure collapsed.
Which leaves us with a final thought for you to mull over. The Kadena blockchain, Chainweb, it's still out there, running, maintained by independent miners and node operators across the globe, a perpetual, technically functional machine. So what's the real value proposition of a network like that if its core innovation engine, the founding team, is gone? If development is effectively frozen? Are the people still holding KDA, owning a piece of a dynamic, growing digital ecosystem? Or are they holding shares in a fascinating, technically impressive, but ultimately static museum piece? Something secure, perhaps, but with no clear path forward. It's a critical question to ask when you look at any L1 project that still heavily relies on its founding entity.